Hello and welcome to our YouTube channel. Today we're going to be talking about high interest rates. The increasing interest rates that we've experienced last year in 2022 and the potential increase of the rates for 2023. Interest rates have been going up and we need to know what happens when interest rates go up. So I'm here to tell you and give you guys some information on how interest rates are going, how these higher interest rates are going to affect the economy. One effect is, of course, borrowing becomes a lot more expensive on individuals and businesses. So this could lead to reduced spending. This could cause the economy to slow down. It has a negative impact on small businesses, such as myself and a lot of you who are small businesses owners, because when the rates are high, it costs us a lot more to borrow money. It's harder to obtain financing from banks and so on and so forth. It costs us more to operate our businesses and to make investments and to hire employees. So it has a negative effect on the small business owners. The higher interest rates also reduces our cash flow, especially on the real estate side, because it's costing us more to, say, for instance, purchase a home. The mortgage is higher, so the cash flow on the rent is a lot less. In addition to that, with the high interest rates, consumers, they tend to spend less as an individual in the household, so there's less disposable income. So if you, say for instance, if you wanted to purchase a new television, because of the high interest rates, you may decide to hold back on that. So this can make it difficult for small business owners to generate income, because the consumer is spending less now because everything costs so much. So it's a challenge, all in all, with the high interest rates, and it's going to be a lot of competition out there. It increases the competition because now everyone is trying to make that sale on the business side. Also, when it comes to mortgages, I just kind of briefed on it. Anybody that has an adjustable mortgage, you need to beware, because every time the rate goes up, your payment goes up. And a lot of times what will happen is, if the feds or the federal government continues to increase interest rates, the people who are on an adjustable mortgage or an ARM, they may not be able to make their payment because the payment kept going up. So what that causes foreclosures. More foreclosures in the market causes the housing price to start basically like a bubble, so to speak. So the foreclosure goes up, more foreclosures on the market. The prices of the house have to come down because the interest rate is so high, so people can't afford as much house as they used to. Additional to that, high interest rates, they can affect the ability for financing. So at one point, say beginning of last year, you could get 80% refinance on a house. You could refinance your house. They give you 80% of what the property is worth on the commercial side. Now on the commercial side, they're only giving away 10%, which is a lot less. And I expect if the feds continue to raise rates, that refinance cash out is going to be a lot less. So you need to stay in tune with what's going on in the economy as far as the interest rates, these higher interest rates, because it's going to affect everyone. No one is immune to being affected from these high interest rates. Now, there are some good things about higher interest rates, and one positive thing is that it leads strongly to the dollar. So higher interest rates makes the dollar stronger, which makes our country stronger as far as when it comes to exporting goods. It makes us more competitive. Another thing is another good reason why higher interest may also reduce inflation, which is what the Feds want to do. Their goal is to reduce inflation, and so this will bring the prices of eggs, milk, cheese, dairy, things like that, cars. Eventually, those prices are going to come down because of the high interest rate. And once everything bottoms out, of course, the Feds will hit the switch. They'll do the reset. They'll probably do some quantitative easing in a few years, and the interest rate will start going down. So as the interest rate goes down, of course, the prices will go up. And they're kind of looking for that balance. Is really what they're looking for. But eventually it gets kind of out of control, and the interest rate continue to go down when money gets cheap and the prices go up. So thanks you guys for watching the channel. Like, subscribe if the information was good to you. Share, like, and share. And thanks for watching our quick presentation on higher interest rates. Hope you learned something. This is Cash Flow Stacy. See you next time. Thank you.